All right, still watching Mid-Cap Data on CNBC TV 18. We promised a market view for you, and that's exactly what we'll bring at this point. Bundeep Singh, chairman of IndusView, joins us with his market check going forward. Bundeep, is it expected to be a phase of consolidation for the market this entire month of September before we can actually make a dash for reclaiming our highs, or you think that is possible in the next few weeks?
Well, consolidation is an interesting word because what powers consolidation is, of course, is a healthy appetite for both credit and, of course, an appetite for sell-side mandates. Now, I think with this current market turmoil, the companies that are best able to leverage the market turmoil, if you may, are those with a strong balance sheet, because borrowing is going to be difficult. So I think consolidation led by strategic investors with strong balance sheets, yes. Any company looking to finance acquisitions will probably have a harder time.
Bundeep, since you've touched on borrowing and M&A right away at the start of this, what did you make of those new ECB norms that were announced just about 3 weeks back from the centre, and would that have any sort of material impact?
They'll certainly impact a lot of small cap and to some degree mid cap stocks because, you know, this sort of ceiling they have of $20 million dollars is going to impact companies that have lower liquidity, lower stock valuations. So in that sense, it will impact the bottom end or the lower end, if you may, of M&A activity. It won't impact the Tatas and Hindalcos of this world, but certainly the smaller companies, I think, yes.
Since you've touched on liquidity and valuations as well, how do you view the liquidity scenario now building up to September 18th, and specifically even post that the October Reserve Bank of India meet over here? And of course, specifically in light of all that, how are valuations currently stacked up in India?
So the valuations now, if you look at, you know, say the CNX mid-cap or the CNX top end of the stock market, if you may, they're certainly down 3 to 4 points from where they were. They're healthier. You know, they're sort of 18 times at the CNX Nifty, which is sort of in line with the 10-year average. And on the small caps, about 16 times. Again, it's about 3 points down where it was before. So it's healthier. And certainly, I think the corrections helped. But I do think that, you know, given the performance of earnings on a forward basis, the earnings have always seemed to have surpassed the 14x that you have on a forward multiple basis. So I think that the valuations are healthier than they were before. Certainly the froth is a bit out of the market. And I think companies that you want to watch out for are those that have less of an international exposure. So it's companies that are not going to suffer from subprime woes in the US. Companies that, you know, the ones that get hit the hardest are generally the larger ones, but they also seem to rally up the fastest. So if you pick them up when they're at the bottom side, you probably have the highest delta of gain, if you may, when the markets come back. Certainly we've seen that in the last week.
In terms of sectoral picks, what is it that you are picking post this correction, Bundeep?
I'm sorry, I missed that. My earpiece is a bit loose. So
in terms of sectoral ideas, which are the pockets where you are making some investments right now, post the correction?
Well, I won't comment on what we're sort of specifically making investments on, but I certainly think the banking sector is good, the pharma sector is good, the consumables sector is very strong. Sectors that are not impacted by, say, commodity prices internationally. And while I do think there's some impact in, say, telecoms or technology that have come down from both the US dollar, rupee exchange rate, as well as the subprime concern, I don't think they're companies to be excluded from your portfolio. But the strong ones certainly seem to be the ones I mentioned before: housing, pharmaceuticals, consumables.
So you would not include metals and autos from that pack?
I would include auto just because of strong growth out here. The metals market, I'm just shirking away from because there's too much uncertainty, and the volatility and the change in metal prices, commodity prices has affected certain stocks. It's not a market I would comment on because it's not one that I look at deeply.
Just want to come back to the liquidity point again, Bundeep, just quickly. We're coming off a month that has seen FIs have about $2 billion worth of outflows from the Indian market. Do you see that as a squeeze going forward for the rest of the calendar year?
I think if you look at the rally in the last week alone, I think the performance of the Indian stock market sort of underlies a general robustness of the market. So I do think the FIIs are not going to be ignorant of this market. They'll come back in. I think their pressures are not, if you may, a push away from the Indian market as much as it is a pull from just domestic concern in the US. And I think the moves by the Federal Reserve and certainly George Bush in the last week or so will help probably, you know, keep some comfort in terms of the credit crisis in the US. But I don't see FIIs pulling away. This is too strong a market, and if anything, if the US is, you know, there's fears about a US recession, given all the impact of subprime and of course the housing concern. the balance against that, the cushioning effect, will come from India and to some degree China, of course. I think if you're looking at international portfolio managers, India is in some ways a way to offset the risk of domestic U.S. concerns.
Thanks a lot for joining us and giving us those views, Bundeep. That's a view from IndusView.